In preparation for the housing crisis, Michael Burry purchased his first credit default swaps on May 19, 2005. Deutsche Bank has offered $60 million in credit default swaps, with $10 million on each of 6 distinct bonds. He was correct in his prognosis that the U.S. mortgage-backed securities, once a reliable and respectable investment instrument, had gradually transformed into a ticking time bomb due to corruption and greed. He felt that this wager was not a gamble. His analysis of residential real estate values led him to conclude that subprime mortgages, particularly those with teaser rates, and the bonds based on these mortgages would lose value once much higher rates replaced the initial rates, frequently in as little as 2 years after initiation. By convincing Goldman Sachs and other investment companies to offer him credit default swaps against subprime deals they believed to be susceptible, he was able to short the market as a result of this conclusion. We're telling you all this because history is repeating itself and Burry is back with some really worrying predictions. Hello everyone, and welcome back to our channel. In today's video, we'll look at Michael Burry's warning about the 2022 stock market crash, so make sure to stay until the end of the video to learn it all. Burry experienced an investor revolt while making payments for the credit default swaps because some fund investors felt his estimates were off and sought their money back. In the end, Burry's prognosis was accurate. He earned a profit of $100 million for himself and more than $700 million for his remaining investors. Between November 1, 2000 and June 2008, Scion Capital generated returns of 489.34%, net of fees and expenditures. Over the same period, the S&P 500, usually regarded as the benchmark for the U.S. market, returned a little under 3%. Michael Burry is best known for correctly predicting the collapse of the housing market in 2008 and profiting as a result. But in recent years, he has turned to Twitter to rail against stock valuations, cryptocurrency bulls, and generally risky investor behavior. The Scion Asset Management CEOs, played by Christian Bale in the 2015 films The Big Short, referred to the stock market as the biggest speculative bubble of all time in all things, and forewarned cryptocurrency investors of the impending mother of all crashes in June 2021. The S&P 500 has decreased by more than 12% since then, while the blue chip index has decreased by 21% in the last 6 months. However, Burry cautioned on Thursday that much more suffering might come. Adjusted for inflation, 2022 first half S&P 500 down 25 to 26%, and NASDAQ down 34 to 35%, Bitcoin down 64 to 65%, he tweeted. That was multiple compression. Next up is earnings compression, so maybe halfway there. After the pandemic crash in the spring of 2020, the S&P 500 index experienced a significant recovery, climbing from a low of 2,192 points to 4,089 points as of Tuesday's close. Burry tweeted on May 3 that it might fall by 54% to 1,862 points during the following few years. Burry pointed out that the S&P 500 has historically traded lower years after a crash. He cited the index as bottoming out at a rate of 13% less in 2009 than it did in 2002, 17% less in 2002 than it did in the midst of the long-term capital management debacle in 1998, and 10% less in 1975 than it did in 1970. Even after posting its worst first-half performance since 1970, if Burry is right and the S&P 500 still has another 25% collapse in store for it, the index may fall as low as 2,800 this year. That's a significant decline, but it's still not as catastrophic as what Burry projected back in May when he said that based on a historical review of previous bear markets, the S&P 500 might go as low as 1,862. Some claim Burry is entering boy who cried wolf territory because of his repeated forecasts of coming economic calamity. On November 2021, Elon Musk even referred to him as a broken clock. However, Burry is not the only one who believes that equities will continue to decline. As the Federal Reserve keeps raising interest rates to fight inflation, George Ball, chairman of Sanders Morris Harris, a Houston-based investment firm with $4.9 billion in assets under management, said in an interview with Fortune that the S&P 500 will fall to 3,100 this year. Ball stated, "We don't think the stock market has bottomed yet, and we predict significant downside coming. The strong but necessary steps taken by the Federal Reserve to combat inflation are likely to hurt business profits and send equities down." Ball agrees with Burry that decreasing consumer spending and the growing cost of borrowing as a result of Federal Reserve interest rate hikes will damage company profitability in the future and drive down stock prices. The majority of Wall Street specialists appear to concur with that conclusion. A study conducted by Deutsche Bank between June 27 and June 29 of more than 475 institutional investors and other market professionals found that 90% of respondents now expect a U.S. recession by the end of 2023, and 72% think the S&P 500 will hit 3,300 before rising to 4,500. A dead cat bounce is a brief increase in stock prices following a sharp decline, frequently due to investors buying shares to cover their losses. In a tweet on May 4th, Burry noted that they'd frequently take place amid significant stock market falls. The implication is that investors shouldn't get too excited about any rallies that may occur in the upcoming months, because they will probably be short-lived respites rather than the start of a market recovery. Burry pointed out that 9 of the S&P 500's 20 highest one-day rallies happened in the wake of the 1929 Great Crash, while 12 of the 20 biggest one-day rallies in the NASDAQ index occurred as the dot-com bubble burst. But don't let the resurgent stock market deceive you. Burry said in a tweet on May 5 that there may be more rises in the stock market before the crash is complete. He pointed out that after the dot-com bubble burst, the NASDAQ rebounded 16 times by more than 10%, averaging gains of 23% each time, before falling by 78% at its lowest point. Burry further underlined that the Dow Jones Index rose 10 times by more than 10% after the Great Crash of 1929, rising by an average of 23% each time, before bottoming out at an 89% drop. Burry remarked in a tweet on May 8 that the U.S. stock market appears to be following the pattern of prior bubbles, putting it in position for a catastrophic crash. The Scion CEOs cited the S&P 500's recent 10-year trajectory, pointing out that it was remarkably similar to the index's chart for the decade preceding the dot-com crash and the Dow's trend for the 10 years before the Great Crash of 1929. Burry claimed that history is repeating itself, and that human nature was to blame for the continuous decade-long buildups. Burry cautioned in a tweet on May 11 that investors should prepare for markets to decline far more. The investor pointed out that between Microsoft's high during the dot-com boom and its bottom in 2002, 5.2 times the company's outstanding shares were traded. During the financial crisis, that number was 3.3 times higher. As of now, it is only 0.5 times higher. Burry pointed out that the situation with Amazon and J.P. Morgan was similar, indicating that it might take some time for those stocks and others to bottom out. The market as a whole might not be flying the same route. Burry has recently invested in new assets rather than pulling his marbles out as he did in the prior quarter as part of the announcement of the mother of all crashes. According to a tax return submitted to the Securities and Exchange Commission each quarter, that is the case. It demonstrates some intriguing strategic choices. Technology equities have been particularly depressed since the start of the year because of the negative environment of increased inflation and interest rates. It may therefore come as a surprise to see Michael Burry invest in Facebook, Meta, and Google Alphabet. Burry has never before included these two equities in his holdings. His stakes in Alphabet and Meta, which are currently the fourth and sixth largest positions in the portfolio, total 65,000 and 80,000 shares, respectively. On the other hand, the tourism industry closely monitors the strength of consumer spending and the impact of inflation. Burry is forecasting major crashes on the one hand, but on the other, he is placing bets on a strong tech rebound, strong vacation numbers, and success in the streaming industry. Burry appears to be a bad omen for Apple alone. Your decision regarding Michael Burry's investments for the upcoming months is entirely up to you. But having such clues is always intriguing, since they help you ponder. With that, it's the end of the video. See you on the next one. Bye-bye.